Good morning, everybody. Welcome to the Trading Market Technicals morning call video for Wednesday, September the 19th. Another inside day from following Monday. We had that big gap up and gains on Thursday and followed through on Friday from the Fed, increasing their asset purchase by $40 billion per month. QE3 is underway, and we've been consolidating ever since. A very, very quiet day. Monday was a Jewish holiday as well, following yesterday. So there was to be expected, nothing absolutely going on. However, I do see that markets are starting to digest the Fed move, and I do think that markets will be underway quite quickly. And last night, we had a little development last night. Bank of Japan actually was the next to follow the Fed's footsteps and expanding their asset purchase program. So we had a spike up in the minis, and they were trading somewhere around 4.5 handles, and yen actually obviously spiked lower, and we put in a little bit of a surge in our commodity currencies. However, that has now a reverse course, and markets are now back to where they were pre Bank of Japan announcement. So markets are tired. They need a rest. There's no question the trend is up. We are trend traders. We like to trade what we see. However, you have to use caution because we are in this sort of conflection point that can we run up to 1,500? Absolutely. We're 50-plus points away. Or can we sell off 150 points? And we can do that as well. Obviously not in one day. So I just want to reiterate caution. I'm looking at the dollar, and I continue to look at the dollar and do extreme analysis on the dollar. And after the post-U.S. dollar sell-off, I could see the dollar losing momentum right now. And the realization is really for ultra-accommodative monetary policy is really not exclusive to the U.S. And it's finally, I do see that it's finally sinking into a lot of the broad-based players. And so I'm looking for dollar strength here in the coming days and weeks. And I'm going to run over some quick charts. Again, guys, I'm going to keep this brief because nothing really happened, but I do want to run over some charts, and I want to show you why I do think that markets will look to pause back. Now, we are not looking to just go out right now and short the market. We want a trigger. We want the market, the S&P, to take out a pivotal low, a back test, and then reestablish a new low, and then we start to look forward to putting on some shorts. That doesn't mean we can't short during the day in an uptrend on a capitulatory move up higher, obviously. But as of right now, markets are just digesting the moves. There's nothing really going on, and we don't want to be pushing ourselves intraday. We want to keep the palate dry when the moves do occur. We want to make sure we're ready for that move. So, bullish percent index of the S&P. As you can see here, we're at 79.5%. Starting to roll over here. We are at lofty levels, so we are still overbought in this indicator. Let's talk about the VIX real quick. As you can see, the VIX actually bounced back up here quite a little bit. Let me see if I can get a little bit bigger here. And then actually started rolling back down again into this big support here from March. So the VIX is going to have to get going. That's one thing that there's extreme complacency in the markets. The long side is a very, very crowded trade. And I'd rather play lightly until a lot of these indicators and this complacency actually starts to unwind itself, because it's very dangerous to be all on one side. Now, I'm not saying the market cannot go higher. I'm just saying to use extreme caution here and just be very selective in your trades. Okay, so now let's take a look at copper. And you know I'm a big fan of copper. I want to show you the weekly chart of copper. We are in this symmetrical triangle that we did break out last week. Now, this is a weekly chart, so today it's only 2 days of data right now. Very, very light volume, as you can see, and we're holding above the outside of the symmetrical triangle. Now, why did I show you this instead of the daily is because I just want to let you know that we are at an uptrend line support of the symmetrical triangle, which is still bullish. So we would need to really break back below this, and I'm not going to show you this until Sunday night, Monday's morning call. But as you can see here, still hanging outside the line, so quite bullish. Let's take a look at the SSEC, which is the Shanghai. And I keep saying why the Shanghai? Shanghai really basically popped us out of the 2009 correction. We followed suit of the Shanghai. They bottomed first, and then we bottomed. Well, this doesn't look like it's bottoming anytime soon. Now, can markets diverge for a long time? Absolutely, it can diverge for a long, long time, and could be more resolvent than we can. So I do see this. This is going to be a problem. And I mentioned the China trade. Well, as you can see, China is continuing to show signs of weakness, and their numbers are coming in and showing us that China will have a hard landing, which will affect global markets, and especially the Australian dollar, the New Zealand dollar. And as you can see, we popped up briefly if you looked at the Australian dollar last night, and then sold off again back to the lows of Wednesday. So this is something that's a concern, but I'd like to see this market actually start to put in a lower high from here and start moving forward to the upside. Then I could say we have a real healthy market. We obviously don't have a healthy market here because we have the Fed intervening, and the market's being just propped up on buybacks, and that's not really the reason why we want to be so excited about the market. But it is what it is, and we need to trade what we trade. So now let's talk about bonds. We have the daily U.S. 30-year Treasury bond. Held the 200-day moving average nicely, right to just about to the penny, and then now we're back, basically popped back up on Monday, and on Tuesday we're just sitting right in here, inside day. Looks like some of these indicators are bottoming here, so something to look at. If the bonds are bottoming, right, and we have the VIX at the lower end of the support area, and now we have the U.S. dollar, which I want to show you. Extreme sell-off, as you can see here, and this was all based, pre-Fed. Now we held this little area, and you can see here there's a big support area here. So this is something that we want to really keep an eye on here. Now the dollar has another bullish falling wedge, but a real deep bullish falling wedge. So something like this will need to break out. As you can see here, we rallied a couple days, so we did have a little weakness in the commodity sector. But if you have the dollar actually sitting at support, as well as commodities and as well as the VIX, and we have extreme complacency reading, we have to really realize that we are due for some sort of a pullback, whether it be a sideways consolidation to unwind this overbought reading, or a correction would actually be dynamite, anywhere from 4 to 5% correction, which is really still not that far away, would be ideal, and that would actually put in a nice fall to winter rally, because as you know, seasonality, we have seasonality weakness coming into September and October. Now we haven't seen that as of yet, and it doesn't have to be, but I want everybody to be alert here that we can literally turn around on a dime at any time. Now we're going to need a catalyst to do so, because if Bank of Japan has actually started their easing as well, you're going to have other world central banks around the world follow suit as well. So they're going to do what it takes to put this market and keep this market elevated. And again, we have the election coming, so we really need to be alert about that. So I would not just look to go and buy VIX calls or look to short the market. Let's get a catalyst, and let's really dig in and say, okay, I think the market here is topping, and we just broke a main pivotal point on the charts, and we're going to look to actually start looking to get short the market. Okay, so that's really it, guys. Kind of quiet. I'm hoping that the markets start picking up steam, which I know they will. It's just a matter of being patient out here. But as soon as we get a little bit more movement, which this week is options expiration, and we usually have, aside from the holiday on Monday, there's usually a bullish bias to the options expiration. So it's going to be a little skewed this week. So I really don't think anything exciting is going to happen until probably sometime next week. But you never know. Keep the pallets dry. Make sure your stop's in place, and make sure we manage our risk properly in this type of environment. Okay? Have a great day, everybody, and we'll talk to you tomorrow. Take care.